warahmatullahi wabarakatuh.
My name is Putri Ramadhanti.
My name is Siti Nurhaliza. We from the Economic and Business Faculty want to fill the assignment of English course.
And we want to explain about statement of change in equity and balance sheet reports.
Of change in equity is financial report that present information about change in capital in the company due to the main activity of the company operation in a particular accounting period. Or it can be interpreted as an overview of change in the amount of capital that occurs during a certain period. Statement of change in equity can be prepared after the statement of profit or loss. Element statement of change in equity. Actually, it is easy to be able to compile a capital change report for someone or accountant must know the elements in this report. These elements are 1. Profit not dividend by initial period per year beginning. 2. Net income accounting period. 3. Dividend announced. 4. Profit are not dividend by the end of the period. The reporting elements of capital change are usually from initial capital, net profit or loss, 5. Capital increase, and the final result. 1. The initial capital. The initial capital is the total fund invested for the development or progress of the company starting from the beginning of the company standing up to a certain time where there has been no additional capital. 2. Net profit or loss. Net profit or loss is the difference from all income with the sum of all expense, as recorded in the income statement. 3. Bribe. Bribe is the withdrawal of a number of capital by the director or company owner or parties who invest for personal needs or other needs. 4. Capital addition. Capital addition is the difference between net income and bribe.
Balance sheet is the one part of the financial statement of the business entity or company in which there is information about assets, liabilities, and equity of shareholders at the end of the accounting period of the company. Financial quotation report, balance sheet, or statement of financial position. Or balance sheet is a report that must be made by company. The report will later become the basis for a business entity or company in making business decisions. There are important elements in the balance sheet, namely assets, liabilities, and equity. The following is an explanation of the balance sheet elements. Firstly, assets. Assets are assets owned by a business entity that are expected to profit business benefit in the future. Assets can be divided into two types, namely 1. Current asset. Current assets are the assets with a useful life for the short term. The process of disbursing this current asset is less than or a maximum of 1 year. Some of which are included in current assets are cash, account receivable, equipment, stock, private expenses. Fixed asset. Fixed assets are assets with a useful life for a long period of time, more than a year. These assets are generally used for the company operational interest, some of which are included in fixed assets are soil, building, machinery, equipment. This type of asset experience depreciation due to usage and reduced lifetime. Capital or equity. Capital is money or good use, a basis for doing a job. In this case, the capital in the balance sheet is the balance of the final capital of a company in one accounting period. In other words, capital or equity is the difference or new value of asset reduced by liabilities. Secondary liability. Liability is a payment obligation that must be carried out by business entity to another party, both in the long term and in the short term. Some include in liability are debt, prepaid income, accrual.